Hello and welcome back, Realty Pros, for another evening's Mastermind training. And we have with us again, Mr. Glenn Donaldson of Velocity Title. And we're always privileged to have him with us, and he always brings us great information and insight. And so I'm going to go ahead and I'm going to just turn it over to you, Glenn.
Wonderful, wonderful. So I know we have on our sort of outline for today, assumable loans, right? And we had left off in our last session with the new version of the as-is addendum and the home inspections and et cetera, et cetera. And I just wanted to real quick open it up to anybody who either wants to text it in or yell out here and jump in. If you had any questions that you might have developed or anything that came about from our last session's topic before we jump into assumables, because while assumables are very, very timely to what's currently happening in the marketplace, they're not overly complicated. So I think we're going to get through them relatively quickly. And I definitely want to encourage some question and answer on the assumables, because it's very applicable to today's current market conditions. But before I go right into that, let me then again reopen the door to any questions that anybody might have from our last session or anything that they may want to touch on. Anybody have anything that they want to ask?
So, Glenn, I just wanted to, because we were accidentally cut off before you were able to share with us. There was one more, I think, thing that you wanted to share with us regarding title insurance.
Yes. So we were talking about the issues relating to title insurance and whether or not, well, there was a couple of points. Thank you, Anita, for bringing that up, because that is a really important question. So a lot of times when I'm talking to real estate professionals, I am communicating my message from a certain perspective, right? I'm trying to one, impart some information to real estate professionals that I think that they will find useful in assisting their clients, and then two, impart some information that I know will help protect you from getting in trouble or from civil liability, right? So we all know the distinction between civil liability and criminal liability, and not too many people in the real estate world get themselves into a criminal liability situation, but many frequently find themselves in a civil liability. So let me paint this with a pretty broad brush relating to questions of title insurance and how it impacts real estate professionals for their client and how it impacts real estate professionals for their own protection. So we talk about civil and criminal liability, and in criminal liability with real estate professionals, as I mentioned, it doesn't happen too frequently where somebody finds themselves in some kind of serious criminal issue related to a real estate transaction. And where that usually happens is where somebody has done something intentionally to defraud their clients, or maybe inappropriately take client funds, escrow monies that could be held, or in one case where that I was involved in, the real estate broker had an office who was taking escrow checks, believe it or not, checks that had been written to the brokerage, and she had set up a separate account with a portion of the brokerage's name, and would then deposit those checks into that account, and she would take the money. Now, that, I mean, clearly everybody understands that that is criminal conduct, right? So a person is going to get themselves in trouble, both civilly, they have to pay the money back, but also criminally, they may face time in jail for stealing people's monies. I mean, that was an egregious example The broker, unfortunately, was liable for paying back some of the money because the person who had stolen it didn't have the money to pay it back to the clients. And the broker had to put money into the account to cover, even though they didn't steal the money, but they still have the obligation to ensure that those funds had been properly deposited and properly cared for, and they didn't have the proper protocols in place. The money was just going into a desk drawer when somebody would leave a check, and that was not sufficient. It was found to protect the client's escrow funds. So the broker did have to put the money back, and unfortunately was never able to have that money reimbursed to her. The civil case, however, the civil claims on real estate professionals is a much more likely scenario because it doesn't require the element of intent to defraud to be liable for a civil claim against you as a real estate professional. It simply requires that you made a mistake. It's a negligence claim. It's a breach of standard of care. So we all know a lawyer, a doctor, an engineer, right? These examples of licensees, if they do something, let's say an engineer is a civil engineer and they're building a bridge and the bridge collapses, well, he didn't intend to kill people on the bridge, but the bridge collapsed. He's negligent in the design and construction, which resulted in death, so he has civil liability. A doctor who makes a mistake in a surgical situation and causes the patient additional injury or death is liable in a civil context because they've breached the standard of care for either that engineer or that doctor. Well, the same rule applies for real estate licensees, right? And lawyers and accountants, etc. You are responsible for the standard of care the same as a similarly situated real estate professional in your local regional area. That is what the law looks at in determining whether a real estate licensee has breached the standard of care and may have civil liability for things they've done that are accidental, negligent, mistake, not intentional, didn't steal money, just a mistake. How does this apply to the title insurance question? Well, there are many times over the years that this has come across my desk where a loan officer, more frequently a loan officer than it is a real estate licensee, but it does happen with real estate licensees. A buyer is buying a house and they're tight on their cash to close. One of the things that can reduce the cash to close is to eliminate the optional owner's title insurance policy. Now, remarkably, it doesn't save all that much money, but it does save a few $100 in most cases, which can reduce the cash to close required by a buyer who may be tight. So the agent or the loan officer says, look, you have optional owner's title, cut that out. We can reduce the cost. And as soon as the agent or the lender makes that recommendation, what they've done is they've put themselves in the position legally of being the title insurer. So what does that mean? If you as a licensee or the loan officer you're working with advises somebody not to get an owner's title insurance policy, and then there is a claim against that title, you are now the insurer and must pay, and will likely be held to account to pay, whatever that default is in the title, defect is in the title. So if let's say you have to clear an easement, right? There's an easement that wasn't disclosed and it's got to be cleared. You might have to pay for it. The loan officer would have to pay for it. It could be like in the situation that we're working on, a prior tax lien, major tax lien. I mean, we can talk hundreds of thousands of dollars in tax liens that can attach. And indeed, this one is well north of $100,000 in the case we're working on. So if the agent who was involved with that client advised them not to buy a policy, and now they have a title defect because they can't sell their home, they can't get a new mortgage, they can't refinance, they can't do anything because there's this tax lien that was hanging out there and no title insurance is paying it off. That is a serious problem. And the agent, the licensee, is going to be now in the position that the title insurance policy would have been in, meaning they have to protect the client. Does that make sense? Does everybody understand what I'm saying on that issue?
That makes sense. Yes, that makes sense. And so, because there are times that, our clients will say, well, what can I do to save money? And so, well, I would never tell anyone not to get the title insurance, but I mean, you can't because I have someone else who just recently did not get title insurance. And, but I did ask the title company, and actually Velocity was a title company, and they did encourage her to get it. But, she wanted to save money, and she was under the mindset that, oh, well, but this is a new construction, like could be nothing on here, that was her thought process, Yeah. And so, so then my question became to her then was, well, can she get this later? And the title agent said she can, but, it will cost a little bit more. So I understand that, you can't make someone get it, but I guess maybe also if they insist, then leave it with them that, it's not they could in the future get it.
Yeah. And Anita, that's a really good point. If you have a situation where your client just says, look, I really don't want to pay for it. I've been told I don't need it by somebody on the internet or whatever. Then have them sign something to you that says I have advised the client in regards to owner's title insurance policy, and they have declined, and have them initial that and put that in your file, because if something happens down the road, then you don't want them coming back, because unfortunately, what happens frequently in cases is, okay, the agent says, look, maybe you should get title insurance. And the buyer says, I need to save money. I'm not going to get title insurance. I'm going to save that money. And then something happens and they have a title defect. Well, what's the first thing they do? They go to a lawyer. And what does that lawyer do? We're going to sue because we need to get some insurance for you. So they sue the brokerage, and they sue the lender, and they sue potentially the title insurance company, and they say nobody advised this client about title insurance. So therefore, you guys were asking all of you to be the indemnifers for this policy. So if you get a client who's saying that, I highly recommend that you get them to sign something that just simply says you've advised and they've declined. Initial it and move on, because then at that point you have no liability. Now I want to you brought up a good point about your client saying, well, this is new construction. So we had a case that I've talked about at Porterhouse a couple of times, I think, in the past. And I ended up working as the the lead attorney of record on this case to resolve all of the title insurance claims related to a forgery in a deed that occurred back in the mid 1900s. So, and it was Montgomery County property. It was a rather large tract of land, in Montgomery County that a farmer had. And if you guys know anything about Montgomery County, as you go out between Rockville and Gaithersburg, you know, that area has just developed since maybe the late 1990s into the 2000s like crazy. Well, closer to Rockville, but just outside of Rockville toward Gaithersburg was this large tract of land. A farmer owned the land and got divorced. His wife went to California. He stayed and farmed the land for a number of years. And at some point, as they got older, he got himself a girlfriend, decided that he was going to sell this tract of land to a developer. And the farmer sold the tract of land, and his girlfriend came in and forged the name of his wife, who was really the partial owner of the property still, but she lived in California and really was just thinking at some point in time in the future she would deal with that. She had moved back with, you know, her family and brothers and sisters in California. Well, as time went on, the developer, of course, subdivided this land. New homes were built on the land, and then subsequently sold to new buyers, et cetera. Some serious amount of time had gone by. Well, the wife passed away in California, and after she passed away, the attorneys who were handling her estate determined that she still had this farm back in Montgomery County, Maryland, all the way across the country. And they started doing some investigation to resolve that for the heirs to her estate, and found out that the farm had been sold. Well, what do you think they did? They immediately then issued demand notices to have the people vacate. The reason I'm telling you that story again is because new construction has nothing to do with title insurance to a large degree. The fact that it's a new build is irrelevant to whether or not there can be a title claim. A title claim attaches from the land and then the building upon the land. So the land gets subdivided. You know, it doesn't matter if you're in a townhouse, single family home, a farm, a multifamily unit, whatever the case may be, that was a large tract of land at some point in history. And then it gets subdivided to smaller pieces and smaller pieces and smaller pieces. And it's just like a pie. You can picture it. You know, you cut up the pie. You can cut it in fours, right? Or you can cut it in sixths or eighths or tenths, whatever it's your desire. Each cut is a subdivision of that whole pie. And each one of those is going to have a title, a new title described for that parcel, that piece. And when that new title gets described, it is either a clear title or a clouded title. And so you may sell a house that's 35 years old. And everybody says, well, we don't need title insurance. The damn thing is 35 years old. You have no idea if 10 years into it, 2 weeks later after they settle, some claim related to a forgery or an improper subdivision is going to be made against that title, or even a foreclosure that wasn't properly noticed during the foreclosure process. And so a creditor comes in and has rights to some of the equity because they were not given notice of the pending foreclosure. So there's lots of different things that can develop a title claim, even though by all outward appearances, everything looks perfect. It is incumbent upon the real estate professional. Now I put my protection hat on. Right now I'm protecting Porterhouse real estate agents from personal liability to themselves and to the company of Porterhouse. When it comes to homeowners insurance, when it comes to title insurance, or anything that acts to indemnify or protect your client from loss, your primary response is you need to have that. Fire insurance is there because it's mandatory. But even let's say it wasn't mandatory, there's no loan. By the way, if you have a cash transaction, is there a requirement to have fire insurance on the house or a homeowner's insurance policy? Anybody want to shoot out an answer to that? If you have a cash transaction, is there a requirement to have a homeowner's insurance, fire insurance policy on that property?
So I'm just thinking, well, I'm thinking a homeowner's insurance or insurance.
Yeah, I'm using those interchangeably. Fire insurance, homeowners insurance, basically the same thing. If it's a cash transaction, is there a requirement to have that policy in place?
I want to say no, because no lender is in jeopardy of, losing out. But I feel like that's a trick question, and it's actually yes.
On mute, I don't know. Okay, so you're correct. I didn't really mean it to be a trick question, but the answer is no, there's no requirement. If you want to pay cash for a property, you do not have to have, under any requirement, under any law, a fire insurance policy. But how many buyers do you think would buy a home without a fire insurance or a homeowner's insurance policy? Probably close to zero, don't you think? I would think that almost nobody would be so foolish. And why is that? Well, the reason is, of course, because the loss, if the house burns down, is catastrophic. If you don't have an insurance policy in place, you lose it all. Title insurance is identical. There's no requirement unless the lender makes you get a lender's policy, which, by the way, all of them do. They're insured. They don't care if you get insured, but they are insured. So a buyer who fails to get a title insurance policy is putting themselves at risk of loss of their entire investment. And if they pay cash or have a large, substantial amount of equity in that property, and it's lost through fire or other hazard, or lost through title hazards, it's the same. They've lost it. It's gone. There's nobody there. There's no safety net to that client to reimburse them for whatever those defects are in the title. So it is one of those situations that doesn't happen much, right? In my career, there's only a couple of people I know, I think throughout my entire career, who ever had a fire at their house. It doesn't happen much, but you can't imagine not having fire insurance. The same with title insurance. It doesn't happen much, but the people should be educated. The people, meaning the customers and clients, purchase home buyers, should be educated. It's not going to happen much, but it's just like if a fire happened to your house, you could lose it all. If something happened in title, you can lose it all. You can have that claim against your title. And the perfect example is a Porterhouse case we're working on right now, where there's a prior tax lien exceeding $100,000. It's there against that person's home. Now, hopefully it can be rectified and we can deal with it, but there's no guarantee of success in this situation. So that's why it's critically important for you benefiting your client to ensure that they understand that, and make sure they understand that it doesn't have to do with how new or old the home is. It goes all the way back. Title insurance issues are allowed to go back by law for 60 years prior. So it's a long time. Make sure they understand that. So Anita, thank you for bringing that up and reminding me about that question that was in our last session. And we can kind of segue that into, unless anybody has any questions, I'll give it a second. If nobody jumps in, then we'll move on. But if anybody has any questions on that relating to title insurance, please just go ahead and yell out. Okay, looks like everybody's good on that. So we wanted to jump into tonight, assumable loans.
And I do have a question.
Yes, ma'am.
So for the group, up until what point is a homeowner able to purchase the title insurance if they declined at settlement?
Okay, that's another great question. So they can purchase it so long as they have not changed ownership at any point in time after they own the home. And the reason it costs a little bit more is because at the time you purchase the house, you're getting what's called a simultaneous issue with the loan that you take on the house. So there's a discount. If you have a loan, the lender gets a lender's policy, you get your buyer gets a simultaneous issue for an owner's policy. So there's a discount that's granted. But there's no limitation to when a homeowner can get a title insurance policy at any time after they own it, or until they change title to something else. Either selling it and changing title to a seller, you can't go back and get it after the fact. Even though you give general warranties, by the way, when you sell your house, you're giving warranties of title, but once you no longer own it, you cannot get a policy in place. And I guess that's kind of a good thing to just touch on real quick. A person who does not have title insurance and they sell their house, in Maryland, they give a warranty deed and they're warranting the title. So if there's no title insurance on the house and the seller who did not have title insurance is warranting that title and it's bad, that's a problem for them. So if you've got a client who says, I don't want title insurance, well, guess what? That title insurance lasts for your entire lifetime. It's not just during the period of time that you own it. So that's something important to remember. Now, another part to your question, Jasmine, is there are a lot of people today who are creating LLCs for different properties they own for one reason or another, whether they're going to be renting those properties or whatever. If you have a title insurance policy in your own name from when you buy a house, but you change title to an LLC, the title insurance policy that you had terminates at the change of title to a corporate or company or entity. So I'll give you the example. I buy a house that I'm going to keep for myself. And I'm living there a couple of years. I got myself a title insurance policy. And then I start dating this, very attractive young lady, and she's really cute and I really like her. And we ultimately end up getting married. I add my wife to title. At that point, does my title insurance terminate? And the answer is no. By adding a spouse to title, it does not impact the title insurance policy that I had in place from purchasing it. But my wife and I now have been living there a few years, and we decided we want to have a bigger place. So I'm going to rent this property out. And like many people, we created an LLC to own that for liability reasons and other reasons. And we transfer title to the LLC. At that point, title insurance terminates and I must get a new policy if I want to remain insured. So, and I think, I'm sorry, Jasmine, I missed your little message there real quick. But I think you were saying, you were just reiterating that on your message. But if you had a question that was in there, please let me know. Title insurance terminates if I change it to an LLC, but not if I just add a spouse, a sibling, a daughter, a brother, something like that. Go ahead, Jasmine.
That was crucial information. I was just typing it into the chat for everybody.
Good. Yeah, it's great you guys ask questions because sometimes you trigger something in my mind that I may neglect to give you. And it is really critical information because it's the small pitfalls that can be missed, and they can end up being big problems. So thank you for that. Now, with respect, I don't think there was anything else, but if I think about it as we're talking tonight, I will circle back and we can touch on it a little bit. But I think that generally covers the owner's title insurance policy. Maybe I just want to pepper that with a moment talking about the lender's policy. Remember, all lenders require title insurance, at least in today's transactions. I think there may be some changes coming in the future. If they do, we of course will convey all of those changes and updates to you as they happen. I think for the next year or 2 years, we're going to remain, maybe even 3, under the current system. So a lender requires title insurance. When that lender requires title insurance, of course, it's always a good idea for the owner to get the policy as well. The lender's policy covers the loan and the loan only. They don't care about the owner's interest. So let's give you the example. A purchase price of $500,000, loan amount is $350,000. The loan policy is $350,000. The owner is exposed for their $150,000 outright, period. And so any losses sustained, the owner would not be covered for, but the bank would be up to their loan amount. So hopefully that makes sense to you guys. So I guess this is kind of a good segue into assumable loans, because with an assumable loan, it's interesting with title insurance, right? You have a situation where there's an existing loan that a new buyer is going to take over. So you've got title changing, but no new loan. So there's a title insurance policy on the old loan and a new owner with a new deed. So before we even jump to the mechanics of the assumable loan, since we're talking about title insurance, let's stay with that for a second and talk about the fact that in an assumption transaction, the existing lender's policy will remain in effect, but the new owner must get a new owner's title insurance policy at the closing, or they will not be insured. So make a note of that, and then maybe bring it down to the bottom of the page as we're talking through the assumption process, that as part of that assumption process, remember they get an new owner's title insurance policy, but their loan policy is going to be exempt. They don't have to buy that one because the lender is already insured for that loan from the seller. Hang tight. Okay.
I apologize, Glenn. Can you? Oh, you still talking.
Scenario for assumable loans to use for buyers and to use for your sellers who may want to list a property. So let's talk about the assumable loan for a second as a general overview. So an assumable loan is a loan that an owner of a property, a seller, they have on their, they have right in place right now before they put their house on the market. And that lender allows a new buyer to come in and purchase the home and assume their existing loan at whatever the interest rate is. So let's give you an example of a situation where in here, we'll use an inverse example. We are currently in 2023, right? The late winter, early spring of 2023. And interest rates are hovering, let's call it 30-year interest rates at 7%. Now, fast forward. Fast forward to 2025, summer, July of 2025, and interest rates have fallen to 3%. Economy has really started to recover. Feds are reducing the Fed rate, and mortgage rates have continued to fall. So we're down at 3%. Pardon me. I'm going to put you guys on hold for a split second. Thank you for your patience, guys. Sorry about that. So,
We've all been there.
yeah, so I'm like, I got this frog in my throat that's been bugging me all day. So we were talking about the rates going down now in 2025 to about 3%. Well, under that scenario, there is just no benefit to having an assumable loan. Assumable loans are beneficial where the interest rates started low and you had a lot of people buying up property at a 2.5% to 3% to 3.25%, 3.5% rate. And then what happens is the rates go up. That's exactly what we have here. A year ago, we were at 3%. We're now at 7%, right? So we've had rate increases so rapidly that home sales are now at the lowest point they've been in nearly 14 years. We haven't had home sales this low in 14 years. That was a Fannie Mae report today, actually, this morning. So It's a substantial drop. So what can help ease that for buyers, right? If you have a seller who's somebody who's interested in selling their home, you can say to them, look, let's move this property. We can do it because we can offer your property as an assumable loan, assumable property at 3%. So the buyer can come in and assume your loan at your rate of 3%. That's extremely attractive when the current rate that they would get is 7%, which is more than double a payment that they would otherwise have. So there's some particulars about the assumable loan, right? One is the lender who's holding the mortgage has to agree that the loan is assumable. Right off the bat, you have FHA and VA loans are both assumable loan products by automatic operation of their documents. The contract documents for VA and FHA have in them that the loans are assumable. There's a process. So if you have a seller who's currently paying on an FHA or a VA loan, and they're paying at 3%, and they want to sell, but they're concerned because, you know, the market's at 7, not a ton of buyers out there at that rate, then you can put it on the market, assumable at 3%. The buyer, right, who's out there, if you're the agent with the buyer who's out there, you know that your buyer has some cash. So maybe the seller owes 300 and is trying to sell the house right now for 400. There's $100,000 in equity. You need a buyer that has that $100,000 in equity in order to assume the $1,000 remaining mortgage balance. Does that make sense? If the house is at 400, there's a loan at 300. Then the buyer coming in and assuming the seller's current loan at 3% must have that $100,000 to give to the seller to walk away. So the buyer does need to have some cash or some capital, unless, of course, the seller doesn't have much equity, in which case it's a great situation for your buyer. They don't have to put up much capital, plus they get to assume the loan at the 3%. The buyers must qualify. That means there's a process. The seller has to contact their lender and identify that their house is for sale, and they intend to have a qualified assumption buyer, and the bank will send them the proper paperwork for that buyer to submit. It's a lot easier than it is a brand new loan, but they still have to qualify. So there is a process. This is critically important for you as a listing agent. With both VA and FHA loans, you must secure what's called a release of liability letter for your seller. It's called a release of liability letter, and it will come directly from FHA and directly from VA. And what that says is, okay, we've approved the buyer to assume your loan at 3%. And as a result, we are releasing you from any liability for this loan if the buyer defaults sometime in the future. If you fail to get the release of liability letter, then the FHA or VA can come back against your client, the seller, if the buyer defaults, and they can ask them to pay money. So you definitely don't want to be in that situation. So if you get an assumption, and it's maybe one of your first assumptions you've ever done, it's a perfect situation, and here we are in a, early spring market. We may very well get some properties and some assumable loan products right now. To me, it's the most opportune time for assumption loans I've ever seen in our marketplace, because there's a ton of loans out there at 2 and 3%, and a lot of properties where people could assume FHA and VA.
Hey,
Um,
Glenn.
Hey, how you doing, man?
I'm good. A quick question.
Good.
So putting on, say, the buyer's hat, right? Is this something that we could actually look at having rolled into as part of our pre-approval, that we could have the buyer already be pre-approved for taking advantage of a seller that's in this position? Because what you were just saying, where, the buyer has to be, if they're not cash heavy, then you'd have to kind of, and a property pops up.
Yeah.
And it's like, oh, wow, this might fit. Could we have already done that? Like just like we do a pre-approval letter,
Yeah, that's a great point and a great question, Curtis. You can do preliminary approval, let's just say analysis for your buyer,
Mhm.
but you're not going to be able to get that full pre-approval because the VA or FHA won't look at it until there's a specific property.
Okay.
Right. So you have to find that property. But what you can do is you can say, look, you guys want to go in an assumption. We know that FHA requires a minimum of whatever it is, 640, 650 credit scores, no current late payments on things, that kind of stuff. So you could say, let's go ahead and let's get that picture of your credit right now, so we know that this is available to you.
Okay.
And then you can go right to, if you're going for an assumption transaction, you don't want to run a situation where you submit for assumable loan and your buyers get denied.
Right.
Right. Yeah, that would be something, everybody would just be flipping out, I'm sure.
Right. Yeah.
Yes. You didn't check these buyers ahead of time? Yeah, right.
Yeah. Okay.
So yeah, great question. I would do the preliminary analysis, make sure they meet the basic FHA VA standard of credit score threshold, and then no current late, and that they should be good to go. It's pretty much that simple, by the way.
Really?
Yeah. The same VA FHA ratios for income to debt are used, credit score threshold, and no current lates.
Okay. Cool.
Yeah.
All right.
Yeah, great question.
Thanks.
So
Glenn, I apologize.
yeah,
Oh,
no
was it-
worries. Hi, Nathan.
So another, just kind of back to the scenario where you were speaking about the loan amount being the 300,000, but the sales price being 400,000, and the buyer needing to bring that $100,000. Is that something that can be financed, or would they have to have that cash?
In certain scenarios, some portion of it can be financed. So there's two qualifiers to that. One, the property has to appraise high enough, right, that you can finance some or all of that $100,000 into that. And then second, the people have to qualify for both the assumption added to that, the amount that they're going to get. Essentially, it's like an equity loan or a second trust.
Right. Okay. And then in that case, that just saying all of that works out. In that case, that 100,000 that is being financed, I guess under, I don't know how to say it other than a new financing, that would fall up under whatever it is that that person whatever interest rate that that person qualifies for at that time. Or
Yes,
it
ma'am.
wouldn't fall up under that. Okay. Right. Okay.
Yeah, you're correct. It wouldn't, the first trust is the current 300,000 that's out there. That's a 3%. The second trust might be at 6 or 6.5% or 7 or whatever it may be out, whatever. So, it just depends. Right now, there may be a ton of properties out there that I can see right now that are doggone close to $300,000 loan amount, $300,000 sales price, real close. You might only have a $10,000 delta, which is what the buyers would have to come up with. It could be a small amount. Closing costs are less because there's no points, there's no, loan, there's a small application fee to FHA and VA, but that's it. So you have a lot of reduction in closing costs. So that there can be some savings there for your buyers who are looking to do an assumption product. We talk about the VA and the FHA. For all intents and purposes, there's no distinction in the assumption process for FHA or VA. So, except for there's one thing to keep in mind. A VA loan is a loan that is guaranteed by the federal government through the Veterans Administration, so that in the event a buyer defaults on the loan, the VA will pay the lender, the servicing lender, 100% of the loss, the loan. And then the VA is the one who initiates the actual underwriting foreclosure process. An FHA, it is an insured loan by the federal government, paid for by the borrower. So you all know FHA mortgage insurance premium, right? That mortgage insurance paid for by your client, by the borrower, is what pays for the loss policy in the event the buyer defaults, so that the lender is paid back in full no matter how much that delta is. So in an FHA transaction that is insured, your buyer pays the MIP, mortgage insurance premium, right? FHA. And they pay each month for approximately 7 to 9 years, depending upon their particular situation, an MIP monthly payment. If at any time during the loan process or during the loan term, the buyer defaults, the mortgage insurance company that's been receiving these payments pays off the lender any money that's lost out of the foreclosure. So when the buyer defaults, foreclosure process starts. Let's say the buyer owes $300,000. At the foreclosure sale, the highest bid is $285,000. It's accepted. That means there's a $15,000 delta or a loss to the lender. They're owed $300,000, but they can only receive $285,000 at the foreclosure. The mortgage insurance company that was receiving the mortgage insurance premium every month on that FHA loan pays the lender that extra $15,000 plus the attorney's fees, plus the lost interest, etc. So all of that is covered by that insurance policy. Whereas the same scenario, but it's a Veterans Administration loan, the VA borrower does not pay a mortgage insurance. The Veterans Administration, through the federal government, guarantees that loan. And so therefore, any delta or loss the lender suffers is paid for directly from essentially all of us taxpayers. The federal government's Treasury Department pays over to the Veterans Administration, who pays it to the lender, any of those losses that are sustained. So That's the distinction. When it comes to assumability, there's little to no distinction because the loan is still guaranteed on the VA side and still insured on the FHA side. However, if you can find a VA loan out there, your buyer over here is not going to have mortgage insurance premiums to pay each month. So you have a great opportunity because your buyer does not have to be a veteran to qualify for the VA assumable loan. Critical important point. Buyers do not have to be veterans to qualify for VA assumability. Any buyer can assume a VA loan. No mortgage insurance. It is great to search for those situations for your buyers if you've got some. They just have to do the basic qualification. Yeah, go ahead. Somebody was opening a mic.
Hey, good. That was me. And I'm so glad you're talking about this because this is the exact situation I'm having with my own property.
Good.
I have an assumable loan, and what I was going to try to do was, I was also the house that I was looking at to buy was an assumable loan. It was a veteran's loan, but
Good.
what they said was that the seller did not want to sell it to a person who was not a veteran because they didn't want to lose their eligibility or something of that nature.
Yes.
So
Okay.
that's what I understood. But they didn't want to go through the thing of trying to get it back. So they said that the only people that they were going to sell it to would be someone who was already a veteran. So I didn't press it, I didn't push it, but that's what I was looking at. But my question is this. So when I do mine and it's assumable, and the amount that I think that the buyer would have to come up with is going to be about $65,000, $75,000. And
Yes.
what we were trying to do was figure out a way where it could be, rolled up in the loan, or it could be financed. They wouldn't have to come up with cash. So
right.
I think what you're saying is my house would have to appraise high enough to include all of that.
It would.
Is that?
Yeah, it would, I'm afraid. And the other possibility, and that's just dependent upon whether it can be approved this way and whether you would want to do it, is what's called a seller take back. It's getting a little bit more complicated in that, but essentially that's where you would hold the payments for the 65 or 75,000 for some period of time, and you can defer payments and structure it that way. There's a lot of different creative ways of handling that, and we could look at it if your buyers are willing to be a little creative to see if it would work for you. I don't know if you want to do it that way. You may want to get your cash out right away, but your house would have to appraise, and they have to qualify in order to have that sort of that equity second trust taken out so they can give you that cash. And I want to touch on what you were dealing with respect to the VA loan assumability and what you were talking about, and that is every veteran, when they get a loan, they have what's called their VA eligibility, and it's a number that a veteran is given that entitles them to certain programs offered at the Veterans Administration. And one of those programs is the VA loan. So when a veteran gets a VA loan, they get some amount of their VA eligibility subtracted so long as that loan is outstanding, meaning unpaid off, right? It's not paid off. It's still out there, even if somebody else is in fact paying it and you have no personal liability. So what they're saying is that particular veteran did not want to have their VA eligibility for another loan somewhere tied up by allowing a non-veteran to assume their existing VA loan. And that can happen out there. There are some people who say, well, I just don't want to let my have my VA eligibility tied up while you're paying off the loan. So therefore, I'm only going to sell to a veteran who will be able to use their own VA eligibility, and I'll get all of mine back. Those are case-by-case situations. It is part of the process. If a VA seller is dealing with you and your buyer, that it's going to come up, and it's going to be something you're going to have to deal with. So I'm sorry that one didn't work out for you with that particular veteran. But if they don't get the right buyer, they may reconsider. There can be some agreements put into place where you hold the VA assumable loan for a period of 2, 3, 5 years or whatever, and then you agree to refinance so that they can have their eligibility back at some point in the future. That might work for them and you too. So again, try and be creative and work it out. Whether you're the seller and you've got buyers who need some cash, you can be creative in that scenario, or whether or not you've got buyers or you are the buyer, you can be creative too, because heck, that's a great loan product. If you can get into it and you can convince that seller to take you on or your client on as an assumable buyer on a VA, it's a great option. Does anybody have any questions this far? I know I'm bleeding over again. Sorry, guys.
Question,
Okay.
just for clarification. So you had said that with the, I understand that a non-VA member can assume a VA loan. And one of the benefits of a VA loan is that they do not carry mortgage insurance. That non-veteran, when they assume that loan, do they then have to get mortgage insurance, or that is one of the perks of being able to assume that loan?
That's a perk.
Okay.
That's a perk.
Okay.
Yeah. If you, and that's why it's, it's the double-edged sword. The perk to your buyer or you is, heck, I can get this at 3%. It's a VA loan. I have no mortgage insurance premium payment at all. That saves you what, $100, $150 a month, which is a lot of money. I mean, if you start adding that stuff up, that's a lot of money. So if you can get that seller who's a veteran, maybe it's an elderly veteran and they're not going to buy another house, or they don't need that eligibility anymore. You can convince them to allow you to assume it, and they may not get their VA eligibility back right away, but it won't matter to them. So you just have to, like anything else, search for the right house and the right seller. But assumables, we're going to see them. And in fact, what I'm going to do, the first real assumable that we have over at Velocity, I'm going to make sure that I get everybody sort of a copy of it to show everybody. You can have the paperwork and see how the whole process works, and we'll get it over to you. So, yeah, go ahead. I'm sorry, somebody. Hi, Angela.
Glenn, can you hear me?
I can, yes.
Okay, can you just touch again on, you mentioned eligibility, I guess, for different folks. I'm unfamiliar with some of this. When you mentioned someone being eligible again, can you clarify that a little bit?
Yeah, so every veteran, when they become a veteran, they get an eligibility stamped to their name, and it's called a VA eligibility. And that eligibility is determined by a number of factors. I'm not 100% sure on all of the factors. I think rank has something to do with it. Years in the service has something to do with it, but they're eligible to get VA loans and other VA benefits. When they use a VA loan, it subtracts a certain amount from their VA eligibility. And then when they pay off that loan, it adds it right back. So now they have their full VA eligibility back when that loan gets paid off. So if that loan is assumed by a buyer and not paid off when the veteran sells the house, they do not get their full VA eligibility back. And that is what some of the veterans are not going to want to have happen. They're going to want to get all of their VA eligibility back. So they need a veteran to buy their house and assume their loan. Because in that case, the VA uses the new buyer's VA eligibility instead of the seller's VA eligibility. Does that make sense, Angela? I hope so.
Yes, thank you.
Okay. So assumptions in general are pretty easy. And what we'll do, like I said, as we go through this next spring market, I know we're going to have some, and I'm going to pull them and make sure that we can get a copy to everybody. I'll get it out to Anita and to Jasmine and make sure that you guys get a copy of an actual assumption settlement and package. Anybody have any questions? Because that really kind of covers it generally tonight, and I'm losing my voice again. I'm sorry about that.
Glenn, thank
Yes.
you. That was I really appreciated that. That was very good.
Good.
Yeah. Do we have any other questions before we? No?
Hey, Glenn, I have
Okay.
one quick question.
Sure.
Where would we see that? Would the listing agent put that in like agent remarks and, potential for assumable loan? Or like, how
Yes.
would we, as on the buying side, know we would see that information?
You should, yeah. And if they don't put it in there, you should ask. But they'd be
Okay.
foolish not to put it in there, right?
Right.
But if you've got a buyer that, Curtis, that might be eligible, you want to make sure that you ask that listing agent, hey, what's the possibility of an assumption on this loan? Is it VA? Is it FHA? I mean, usually, right? You remind me, it's been a while since I've looked at an MLS printout, but most of them have the seller's existing loan, don't they? Don't they show FHA or VA payoff?
Well,
I
it'll
can't
show, I guess, depending on what you're looking at, if I'm just looking at Home Snap or like, I'll see, you'll see FHA, VA loan, but just that specific language of like, hey, this, the potential for an
Yes.
assumable loan, would be, I guess, in the agent remarks or, that
Yep.
agent letting people know like, hey, we're trying to sell this and assume the loan.
Yeah, and look, some agents, I mean, assumptions have been not a very well-used product for a lot of years because the market conditions were not there for assumptions.
Mhm.
They are now. So there's a lot of agents who probably aren't even familiar with it or are afraid of it, don't understand it, and so they're not even putting it out there. So don't be afraid to aggressively go after marketing that to a listing agent. Say, look, we
Right.
can do this as an assumable, and my buyers have enough cash capital, they qualify, and they'd love to have your sellers 3%
Mhm.
rate. And it doesn't hurt the seller as long as the release of liability goes through.
Okay.
So that's good. And by the way, I should make mention, under certain conditions, the conventional loans can also be assumable, but there's a little bit more of a process to it.
Okay, cool. Thanks, Glenn.
Yep, you got it. Well, okay, guys, That was a quick hour and 15. So Anita, I'm going to turn it over to you and wrap up tonight. And Jasmine, as always, great to see you again. And again, anybody, feel free, email, text, or whatever, and pass out my number to everybody. Texts are always better. I'm in court a lot right now, it seems, for some reason. So texts and emails are always great. All right, guys, have a great night. Well, thank you. Yeah, good. It is good information right now, and it's very timely.
Yes, it was. Thank you so much.
Okay, guys, have a great night. We'll talk to everybody soon.
Have a good night, everybody.
Right.